What is leverage in financial markets trading? Let's talk about that in this short video. Okay, so what is leverage? Well, it's something that allows you to multiply your exposure to a financial asset. Well, what does that mean then? Well, I like to compare it with buying a house or buying a flat. So say that we want to buy a property and it costs $500,000. Most people, they don't have $500,000. So what they do is they go to the bank. And when you go to the bank, they say, okay, what's your deposit? In this case, we have a $100,000 deposit. So we have $100,000. The bank is going to lend us $400,000. In total, it becomes $500,000, and we can pay the seller. Now, if you take 500,000 and divide that by 100,000, then that's 5 times. That is financial market. Oh, that is leverage. Now, when you're trading, it works the same. So say, for example, you want to buy something worth $500,000. Say you want to buy $500,000. You can do that even if you don't have $500,000. In this example, we would have a deposit of 100,000. So then our effective leverage would be 5 times it. So what is margin then? Margin is the deposit. So in the property example, we wanted to buy for $500,000 with $100,000 deposit. That is our margin when we trade. Now, it's a bit different though, because when you buy the property, your deposit actually goes back to, or goes to the seller, right? Of course, if you can sell back the property, say you buy for $500,000, you live there for 2 years, and then you want to move out because you got another job, a good job in another part of the country, or just want to move away. If you can sell the property back for $500,000, then you get the 400 back to the bank, and you get 100,000. So something similar to that when you trade financial markets. So you would usually say buy for $500,000, but the broker, they set 100,000 to the side. It's not that it's going to cost you nothing, but they just set that to the side, and then you can trade. And when you have depleted your deposit, they would usually close your account. So you need to bear that in mind, because it might sound great that you can buy with leverage, but there's also higher risks with that. We're going to talk about that in a minute or two. So for example, if you would buy for $500,000 and then that position goes against you because something big happened, as soon as you depleted your deposit, then that would be when you're getting a margin call, and the broker will effectively close your position. Now, the deposit is what we call margin. So you can see that there's a relationship between the deposit size and the position and the leverage. So there's a simple formula for that. You take whatever you want to buy and divide that by the leverage, and that gives you the margin. So let's bring out a calculator. Here it says 20 to 1, so that's 20 times leverage. Here's 30 to 1, so that is 30 times leverage. So say, for example, I want to buy something. I want to buy something for, say, $50,000. And I know that the effective leverage with my broker is 30 times. Then 50,000 divided by 30, that means that to buy a whole open position for 50,000, I need to put $1,666 as a deposit. And that is also the equivalent of 3.33%. So half 50,000 by 0.0333 is pretty much the same amount as we had before. And that is the relationship between margin and leverage. Now, when we're trading, let me explain how that would work. So we're trading a currency, right? And we have 30 to 1 times leverage. We want to buy one lot. That will be 100,000 units. So we want to control a position with worth $100,000, and we know that the leverage is 30. So that means we need to have $3,333 to open that position, and we control this. Now, this is really important to understand. So when you're making profits and losses, you actually do that on the total figure. You don't do that just on your position. So if this position goes up with 1%, then that would be a profit of $1,000, right? So $1,000 profit. Now, $1,000 over your deposit, that's 30 times the money, more or less, right? So that's the great thing with leverage. If you would maximize and you would effectively buy with 30 times leverage, well, if the market goes up with 1%, then you make 30%. But if the market goes down with 1%, you would lose 30%. So that means that you need to be very careful. Back in the old days, you used to be able to trade with 200 times leverage. And there's still some brokers, especially offshore, which can allow you to do it 500 or 200. You don't need to trade with that leverage. Most professionals trade with maybe 1 times up to maximum 10 times leverage. Because if you have a 1% move in the market, which is really happens quite frequently, you would effectively make 10% of your account. So bear that in mind. Margin trading or leverage trading will amplify your profits, but it will also amplify your losses. Now, if you like this video, don't forget to like it. That will be really appreciated as well. If you like more content like this, then you stick with us. There's more content coming up after this. Thanks much, and talk to you guys soon.